we on? Everybody, the microphone's alive. Are we back, okay back there, Justin?
Yeah,
Thank you.
yes.
Well, good morning and welcome to the May 23rd meeting of the Town of Merrimack Trustees of Trust Funds. Our first item on the agenda is introductions. I'm Chris Christensen, and to my right is,
Bill Wilkes, trustee.
and to my left,
Liz Petrides, trustee.
Kathy Scher, alternate.
Paul Calabria, Finance Director.
thank you all. And in the audience we have,
Susan Martori Baker, Cambridge Trust, President, New Hampshire. Lisa Turanjo, the Relationship Manager. Lindsay Donovan, Portfolio Manager. And our new Chief Investment Officer, Ryan Hanna. welcome.
haven't seen Susan in quite a while. That's a smiling face we like to see. And Ryan, welcome aboard. Is this going to be a regular, or are you just filling in today?
Sort of filling in.
They needed reinforcements to handle us today.
Well, we're actually here to thank you for your relationship. It has been a long relationship, and hopefully you feel it's been a very successful relationship. As you know, we are going through a merger with Eastern Bank, but that won't affect the wealth management division of Cambridge Trust. So you can continue to enjoy the same relationship team as well as the same investment strategies that you have previously. So thank you.
Excellent.
Well, thank you.
Thank
Glad
you.
to hear it. And I hope the success brings further success, or the merger brings further success. So the first item on the agenda quickly is the minutes of April 19th. Do we have a motion?
I'll make a motion to approve the minutes of April 19th as written.
Second.
Any corrections, changes, additions? All set. All in favor signify by saying aye.
Aye.
Aye. 300. And Cambridge Trust, you've got the floor.
Thank you. So you should all have an investment presentation in front of you, and it's also on the screen, so I'll be moving the slide deck along. To start with an executive summary, so through the end of April 30th, the S&P was up 6.02%, and the NASDAQ U.S. Broad Dividend Achievers Index was up 3.17%. May has been an even stronger month compared to the first 4 months of the year. So through year-to-date May 22nd, the S&P was up 11.26%, and the NASDAQ was up 11.93%. So May has been a strong month. Interest rates have risen so far this year based on better economic reports. The market was originally pricing in 5 to 6 interest rate cuts by the end of the year. However, looking at world interest rate probabilities through Bloomberg, as well as different strategists, the number of interest rate hikes has been, cuts has been decreased at this point to 1 to 2, based on stronger than expected CPI numbers, as well as low unemployment, which remains consistent at this point. Equity valuations are not cheap, but we do still like the space. They're not overly expensive at this point, with 11% earnings growth that's expected for this year. And as Susan mentioned, we do have our Chief Investment Officer, Ryan Hanna, here as well for any questions that you may have about the equity market specifically. It's a great resource. So returns this year have been more broad-based compared to last year, where we did see a very heavy concentration within the Magnificent Seven. So it's been great to see this more broad-based return and the market performing with a wider array of performance. So not just that concentration within those 7 particular stocks last year. And then just to wrap up, we are cognizant that this is an election year coming up. And while historically we do see positive returns that have been generated, there are heightened geopolitical risks this year, and there is more volatility. So just to set the stage for the second half of this year.
Mr. Chair, may I ask a question?
Absolutely.
Lindsay, are you hearing the same thing that I heard at a recent conference, that the only cut probably this year will be in December post-election, or are you hearing something before that?
So world interest rate probabilities, which I do have a slide on that later on in the deck, is still pricing between 1 or 2. And it's not specifically saying the December meeting. It starts ticking up after the September meeting.
Okay.
So the specificity of when that hike will happen is still a little bit uncertain at this point. But right now, the market is still pricing in somewhere between 1 and 2. And we have seen the cuts drop significantly since the beginning of the year, when we were looking at a full 6 being priced into the market.
Thank you.
You're welcome.
I think the backup question to that is, especially on the preponderance of bonds and CDs that we hold, do you think that's going to affect how we ladder things?
So we do still like adding duration to the portfolio at this point. We're slightly overweight to duration, and we think that both treasuries and CDs are attractive to hold at this point, where we're seeing the highest yields that we've seen in the past decade. So being able to lock in some of these rates here, given the prospect of falling rates going into the future, is an attractive scenario, according to our research.
How about utilities as far as equity holdings? They've gone up a fair amount this year. How do you feel about them going forward?
In the last month or two, as the prospect for interest rates has started to fall, Lindsay referenced the fact that we've seen broad-based participation. Utilities, real estate, and financials have been 3 of the sectors that have outperformed. And I think that is the beginning of the market starting to price in lower rates ahead. So it confirms what Lindsay was saying about your fixed income holdings, but it also is starting to show the broadening out of the market, and some of the more rate-sensitive sectors like utilities starting to do a little bit better. Those sectors have underperformed pretty dramatically over the last couple of years as growth stocks really took off. And as interest rates were rising, there was a competition for capital between fixed income and some of these dividend-paying sectors. So if interest rates do start to fall, then the prospect for utilities will be pretty favorable.
And you think that it's going to continue on?
Yes, I think there's fundamental reasons why utilities will continue to do well. Power demand is going up as a result of AI and other related power requirements, increasing power demand. So the fundamental backdrop is pretty favorable. Valuations look much more attractive, and with 4% plus dividend yields, looks like an interesting total return opportunity for utilities.
So would you see us putting more weight into that area for our portfolio?
We do already have some weight to that area. Let me just grab the holdings. I think part of it depends on the new individual ideas that are pitched by the equity team for adding more to the utility space. If we find individual issues that we find compelling and a good valuation.
Utilities will be a good space to add to if the confirmation is that rates do continue to fall. But I also think that REITs and financials will also be another area of the market that
What,
will.
specifically in REITs, what segments or sectors do you expect?
Right, so
I
right
mean,
now.
obviously, everybody talks about the office market being terrible, and then there's the retail, and then there's all kinds of other ones,
Right.
elderly housing, apartments, et cetera, et cetera.
Yep. Most of our exposure is to industrial REITs, so think about warehousing and factories, companies that serve Amazon, FedEx, they lease space to FedEx because e-commerce is growing as a percentage of consumer sales. So some of these warehouse spaces need to grow. So Amazon, UPS, FedEx are leasing more and more space. So a company like Prologis is a name in that space that we've invested in. We feel like the prospects there are very good, very differentiated from maybe the malls or some of the other subsegments, like you mentioned, commercial real estate that are unattractive to us.
You familiar with Rexford?
Rexford, I'm not.
Okay.
All right, let's go back to the presentation, and when we get through that, then we can, because we could go all day on sidetracks.
Great.
Thank you.
I did just want to additionally make a note, the Fed minutes from the April 30th to May 1st meeting were released yesterday. The minutes reference that there are many officials questioning if the policy is restrictive enough. So that again just showcases that the possibility for cuts later this year are still being priced in by the market, but we are starting to see that that restrictive, potentially more tightening being needed, being thrown around by the Fed. So just to present that as well. Looking at the portfolio summary for the overall portfolio yields, the overall yields for the scholarship fund as of the end of April was 3.57%. For the principal fund was 3.67%, and for the income fund was 3.55%. Looking at the individual breakdowns, we did see a little bit of a drop from the equity yield side within those three funds. However, the bond yields have remained strong and have actually risen since the end of October. The equity market has continued to rally. So we've seen that strong performance within equities this year. But overall, still seeing strong yields and continuing to keep that as a focus within these portfolios. So looking at individual portfolio performance, on the year-to-date basis, equity returns have outperformed versus the benchmark, the NASDAQ US Broad Dividend Achievers Index, with the common income fund returning 4%, the principal fund returning 5.85%, and the scholarship fund returning 5.39%, versus the index return of 3.17%. Bond returns have outperformed due to the exposure to high-quality corporate bonds. We have continued to prefer high quality over the more speculative areas within the corporate bond markets and have increased quality over time. And we do still find attractive yields in that space. More recently, we have been focused on adding growth stocks to the common income fund, which we are seeing some of that yield differential, and the equity returns are starting to differentiate a bit more between income and the other two portfolios due to the change of stocks within those two portfolios. And then looking at the capital reserve funds, water, municipal, and school portfolios are all positioned for liquidity needs and for the safety of principal. So we are investing in CDs as well as treasury bills. Portfolios have been laddered out through 3 years for maturities, and to your question earlier, we are continuing to add to that 3-year space to continue to build out further into the future to lock in some of these rates for the next 3 years. And portfolio durations for all three funds are approximately 1 year at this point. Next page, we have a global asset class performance summary that's looking as of March 31st. So you can see the breakdown between the different indices, equities, fixed income, some key rates that we follow. One important metric that we do follow is the 210 spread between the Treasury curve. Right now it's still inverted, 45 basis points. It is continuing to flatten, although with the meeting minutes yesterday that came out, we did see a little bit more movement with the 2-year continuing to back up, and the 10-year not backing up quite as much as the front end. Looking at S&P 500 valuations, reference this in the executive summary. Multiples are not cheap, but we do still find them to be reasonable, and we are finding attractive opportunities. We are equal weighted, so neutral within portfolio positioning right now, and finding good opportunities to put money to work. We are expecting a solid earnings recovery this year compared to last year's earnings recession. Both revenue growth and margin expansion will continue to be key drivers here. 11% expected earnings growth this year, and 2025 is also expected to be positive for earnings growth at this point. Fixed income yields, we're not at the highest percentile anymore. That was last year, that we've seen within yields over the past decade, but we still do find them very attractive versus the prior decade of low rates that we did see. So we are finding attractive opportunities. U.S. Treasuries, 4.4% for the 10-year at this point is still very attractive. And we are finding spread above that level for investment-grade corporates, mortgage-backed securities, as well as opportunistically within high-yield and emerging market debt markets at this point. We have been seeing the investment-grade corporate market becoming tighter from a valuation basis. So we are focusing on security selection there and have taken our position to a neutral basis. And then to reference the Fed futures markets, this was taken on 5/14, so it's a little bit older at this point, but I checked the page last night, and numbers still really haven't changed. We are still pricing in about 1 to 2 cuts by the end of the year at this point. And then for appendices, we do have the individual performance for each of the portfolios, and I'm happy to go through that now if you'd like, or we could open it up to questions.
Well, before we do questions, do you have anything that you think out of the next 3 or 4 summary pages that really jumps out at you?
Let me just go quickly through performance so we can just highlight it. First up, we do have the capital reserve fund for the municipals, and I know that there is the June outflow that will happen. So currently looking at cash and enhanced cash of $3.9 million. Part of that is within the income portfolio as well. Over the year-to-date period, the portfolio is up 1.49%. Looking back to since inception, the portfolio is up 1.22%. For the Village District Water portfolio, there is $5 million currently in cash. Let me just flip. On a year-to-date basis, the portfolio is up 1.65%, with the since inception up 1.46%. For the principal portfolio, we are positioned for growth within this portfolio. 66% within equities, 32% within fixed income, running 0.3% in cash currently, with alternatives at 1.6%. And you can see the balance over on the upper right-hand side of the asset allocation over time. So holding fairly consistent over time there. On the year-to-date period, total return has been 3.75%, and this is as of April 30th, with equities up 5.85% versus the benchmark up 2.52%. Fixed income up down 0.26% versus the benchmark down 1.5%. So some outperformance within each of those areas. And since inception, the portfolio has been up 8.69% over that time period. For the income portfolio, following a moderate growth, asset allocation with 60% in equities, 33% in fixed income, 5.6% in cash, and 1.2% in alternatives. On the year-to-date basis, the total return is up 2.46%, with equities up 4% versus the benchmark of 2.52%. And since inception, the portfolio is up 8.32%. For the school district, which is another capital reserve fund, currently $1 million in cash. And for the total return, the portfolio is up 1.64% on the year-to-date basis and 1.27% since inception. And finally, the scholarship portfolio, which is managed for growth. Equities are at 65% of the portfolio, fixed income 23%, cash and enhanced cash is currently at 11%. And for performance, total return on the year-to-date has been 3.55%, with equities up 5.39% versus the benchmark at 2.52, with fixed income down 0.42 versus negative 1.5 for the benchmark. And since inception, the entire portfolio is up 7.88%. Oh, and I'm sorry, there is the Barry Quimby Memorial Common Fund, which is managed for a balanced allocation. Currently 46% in equities, 47.9% in fixed income, with 5.9% in cash. And on a year-to-date basis, that portfolio is up 40 basis points, with 1.9 from equities versus the benchmark at 5.4%, and fixed income down 1.18% versus the benchmark 1.15%. And this portfolio is managed within our mutual fund model due to the size and the specifics around the investment portfolio requirements.
Yeah, unfortunately, from our point of view, we're restricted on what we can do with that fund, so you do the best you can, I guess. Okay, let's open it up for questions. I want to backtrack just a little, or go ahead a little bit on the agenda. Paul, do you have any close estimates on what we're going to be withdrawing from the town capital reserve fund?
I talked to Mr. McCallie this morning, the town manager, and we're looking at about 1.5 mil.
Oh, that's about 500,000 less than I was expecting. Good news. We have a couple of last-minute requests from the MVD for a couple of withdrawals, and nothing coming out from the school. So we'll press on with those things as we get further down the agenda.
Great. So we do have a little bit of excess cash within the Merrimack, the large municipal fund. So we will put that back out to the ladder, knowing that $1.5 million will be the withdrawal amount.
Estimated.
Okay. So should we continue to estimate that it's
prepared for
around
two.
2? Okay.
Then we can start investing on June 15th or something.
Great. Thank you.
Thank you.
We'll know, we'll have a firm number sometime in June. We'll wire the money back to the town, and then we're free for another year.
Great.
For background information, the town pretty much, I wish they'd give it to us in July, but they give us money in December after the taxes come in, even though we get taxes in July as well. So then we only get that money for 6 months, and then they're spending it again. The school district barely uses capital reserve funds, and the MVD makes good use of capital reserve funds, but they withdraw several times throughout the year for various, well, this time to buy a couple of trucks. So, different perspective from each of the three bodies. And I'm just curious, this kind of comes to mind, with those three different approaches, I'm curious what you see from other towns, how they're using their capital reserve funds. Should we be encouraging the town or the MVD, or, I always try to hit the school and tell them they ought to be using them. Do you see variations around the state, or are we pretty much parallel?
I would say pretty much parallel. We do often see, expected budgets from the town on different utilization. It's very helpful to us to know when potential withdrawals might be coming so that we can make sure that there's sufficient liquidity. But I would invite Lisa to answer this as well. But I think that it's consistent with other towns that we manage.
Yes, I agree with that. Typically, if towns distribute more than once a year, they will distribute sort of on a quarterly basis. Yeah, I think Lindsay's spot on.
Thank you. That's always nice to have that different perspective that we didn't have when we were managing the funds ourselves. Questions from the floor, or from the board, I should say.
I'd like to know more about like your growth strategy. The last meeting, we talked about maybe putting up to 10% into growth. I mean, obviously, we've got the Super 7 or the Fantastic 5 or whatever. Tesla, I think, is falling off of that. And I don't know if anybody else has or whatever, but I mean, those might be like shooting fish in a barrel or whatever, but tell me a little bit more about how you select growth stocks.
So the process is pretty consistent. Obviously, from a bottom-up standpoint, we look for secular trends that are sustainable over a period of time, and we try to find sort of the best ideas that fit into those sustainable trends. So we marry the top-down view, which is a macro business cycle thematic approach, with a bottom-ups approach, which is basically finding a stock that looks undervalued to us that marries the thematic with the individual stock selection. We have a lot that fall into our core strategy tends to be a large cap quality growth strategy. And the themes behind that tend to be above average earnings growth, above average dividend growth, above average profitability, above average free cash flow, and overall return metrics being better than average. The equity income fund tends to look at things a little bit different. It looks at free cash flow profile, dividend sustainability, and things like that. So all with a quality bias on everything we look at. So our growth funds, we tend to be more heavily invested in technology. We tend to be more heavily invested in areas within healthcare or industrials that are more maybe cyclically exposed in different areas. Our belief at the end of the day is that usually your higher multiple reflects a higher opportunity for future growth, and lower multiple or deep value can be tricky, right? So within healthcare right now, we prefer a Merck to a Bristol Myers. Merck has a better growth profile, a better pipeline of drugs, and trades at a PE multiple that's almost twice what Bristol Myers is. So Bristol might be great for a dividend-based investor, but it's not going to provide a capital appreciation opportunity. Another example is telecom, right? Telecom, Verizon, AT&T, they pay great dividends, 5-6% dividend yield, maybe a little bit higher, but the total return profile is typically negative. So as we look at a communication service sector, the growth is in the Metas and the Alphabets and the Netflix, and then secularly challenged companies like Comcast, where more people are cutting the cord and more people are moving away from traditional cable towards streaming. We view that as secularly challenged, and those are areas that we would typically minimize, maybe not avoid entirely if there's a dividend requirement to a fund. So we look at every sector through that prism. Where's the growth opportunity? Where are the secularly challenged opportunities? And we try to move more money towards the areas that have good, sustainable secular trends. Sector by sector, we kind of view that.
So do you still like a Meta or an Alphabet?
Absolutely.
Berkshire Hathaway? I mean, are those all companies that you would still invest in at this point?
Yes.
And they've all gone very high?
Yep.
Microsoft?
Yep. So the huge secular trend right now is artificial intelligence and generative AI. Yesterday, NVIDIA, semiconductor company, produced 270% year-over-year revenue growth. Now, this is a $2.5 trillion market cap company that just grew revenues 200% plus year over year. So there's clearly a massive, massive shift towards these GPUs and the demand for the product they're putting out, whether that's for artificial intelligence, whether it's for data centers, whether it's for the Microsofts of the world to help run some of these chatbots and ChatGPT and things like that. The demand is certainly there, and it's broadening out. And the amount of companies that are trying to get their hands on these chips are through the roof. And you're starting to see more and more companies talk about, in earnings calls, the ability to start to monetize artificial intelligence over time and going forward. So we still like all of those companies you referenced, the Alphabets, the Metas, the Amazons, Microsofts, because they are the clear leader in this space. They are clearly the ones that have scale, that have the pocketbooks and have the balance sheets to be able to support and invest in these things.
So do you think, to pick on NVIDIA a little bit,
Mhm.
do you think NVIDIA is going to be able to maintain their margins and their market share, or do you think the AMDs, the Intels, the Microsofts that are all out there developing AI chips aren't going to go after some of that market share, which will compress the margins for NVIDIA? I mean, NVIDIA looks great now in, you know, the 800-pound gorilla, but I just heard on coming in here that somebody's speaking about NVIDIA and the whole situation and saying that these other companies aren't going to sit still. I mean, they're formidable companies. They're not small entities. What do you think about that?
So a lot of it goes into years and years and years of investment ahead of this. I think Intel has been a structurally challenged company for the last decade because their primary focus was PCs. And the PC market has slowed, and they have fallen further and further behind some of these other companies who have been on the cutting edge of innovation. NVIDIA is one, AMD is one, although within the data center space right now, NVIDIA owns about 90% of the market. And AMD is fighting for that other 10%. Intel is fighting for that other 10%. But they're so far behind, and part of the ecosystem that's being developed within the NVIDIA ecosystem, it's hardware and it's software, it's combined, which makes it sort of more attractive to an enterprise. Intel may only offer the chip. They may only offer the hardware portion. So the integration of both hardware and software makes that a more difficult technology to supplant. I think they have such a head start. They have such a large portion of the market share, and the addressable market is still growing exponentially. So when you combine those factors, we think the runway for an NVIDIA is still pretty large. Will they maintain 90% market share? I don't think they have to. Even if they fell to 70% market share and the addressable market continues to grow, then I continue to think that they will be a dominant leader in the semi space for years to come.
So what about, and one last question, then I'll let the rest of the audience speak up, but,
Thank you, Bill.
so, I was in the semiconductor industry, so it's a loaded question. Here's your NVIDIA chip. Does that just drop in and all of a sudden, poof, you've got NVIDIA spitting out AI? It doesn't. All the stuff that goes around here, power systems and support components, do you ever look into stuff like that?
Yes.
Because you can't have an NVIDIA chip with a lot of other components around it.
Absolutely.
And I never hear of anybody talking about, if NVIDIA is gonna grow and AI is gonna explode like it is, all those other supported chips have to come along. So do you ever look at that stuff?
Yes, of course. I think within, if I could take a step back and just kind of lay out sort of our process just a little bit. We have dedicated analysts who cover every individual sector of the market. So I have, on the equity team, we have an equity analyst who covers technology. He covers semis, he covers hardware, software, and every other sub-industry within technology. He is our subject matter expert that researches and develops investment thesis behind just about all of our investments in technology. So yes, he's looking at semi-cap equipment companies, he's looking at power companies, he's looking at software, hardware, and all the others that kind of go into the component of that. In our growth fund, we own an Arista Networks, which is effectively the connectors that go into the data center, right? So there's different components of the supply chain and the value chain that we invest in. It's not all about NVIDIA. However, NVIDIA is such a large, it's, as you said, the 800-pound gorilla. It's sort of inherent upon us to have a view of NVIDIA and its importance to the market. And then obviously by design, all the other sort of subcomponents and parts that go into that. And it's not just within tech. It goes into other companies that manage how hot the data centers get and trying to cool data centers. It's power demand, it's copper demand, it's all of the things that are going into building data centers where these chips are living that makes the whole story kind of come together. NVIDIA is one part of it, a very big part of it, but certainly we're looking at other areas within the spectrum that would sort of fit in. And that's why I started with the thematic approach, right? I think we take a top-down view of what's happening in the world, how is it impacting, and who are the players, and understanding how artificial intelligence, how these chips are being utilized within healthcare, within consumer companies, within industrial companies, within utilities, within tech by itself. So I think we take a pretty holistic approach to it. And then we would sort of overlay our criteria of what's quality and what has consistency of earnings, consistency of cash flow, consistency of profitability. And if it meets our criteria, we would include it in a portfolio.
All set?
I said I'd shut up for now.
Liz or Kathy, anything at this point, or
Nothing for me right now, thank you.
Kathy?
No, thank you.
I have a couple of questions about specific trades in the common fund portfolios. We had, I'm gonna call it a significant holding in Rio Tinto. And we sold about $90,000 worth of it. And we bought about $90,000 worth of Best Buy. And I'm looking at it and saying, okay, Rio is materials sector. Best Buy is consumer discretionary. So if we wanted to be in either of those sectors, I didn't understand how we moved from one to the other. We're getting a 6.5, 6.7% yield from Rio 4% from Best Buy in a portfolio that is yield-oriented. So I'm just curious what the thought process was that made that one just stuck out because of the dollar amount.
So Rio Tinto has traded in a range between $60 and $80 for probably the last 4.5 or 5 years. The run-up, when we bought it, part of the thesis behind it was that iron ore prices were rising. The vast majority of revenue comes from iron ore, right? Mining in Australia, the wild card is China is a huge iron ore producer, and they flood the market from time to time and drive prices lower. And when demand from China slows, demand for iron ore slows. As a result, pricing falls. Rio Tinto's dividend strategy is based on free cash flow. Free cash flow is a result of price. So when price falls, the free cash flow falls, and the dividends that they were paying out were going down. For 4 or 5 years, they paid special dividends in addition to regular dividends, special dividends that now have basically gone away. So on a backward-looking basis, the yield that you quoted was probably right, 6.5%. I think today, on a forward-looking basis, it's like less than 5, because forward-looking, they're not going to pay the special dividends that they were paying in the past. Best Buy, on the other hand, and again, we would tend not to look at it on a sector-to-sector basis, like we took from materials to buy discretionary. We tried to duplicate the yield. I think Best Buy right now is at a 5.2% yield. Don't quote me, plus or minus. The difference being 2 or 3 things. Best Buy is increasing its dividend consistently and has over the last 5 to 7 years, every year. So the compounded growth rate on dividends is around 10 or 11% for Best Buy. So we can see a visibility path on Best Buy dividends that's continuing to grow and going up to the right, whereas Rio Tinto is going down to the right. I think that's a better cash flow profile. Not to get too deep in the weeds, but everybody bought computers and everybody bought TVs and things during COVID. We're 4 or 5 years past the COVID peak, and we're getting back into a replacement cycle. In addition to some of these new chips that are being developed that have explicit AI sort of power and applications baked into the computers, we feel like we're on the cusp of a product cycle, whether that's Apple and its new iPads that were just released a couple of weeks ago, or whether it's just the PCs that are going to start to inflect higher. We feel like there was an opportunity to sort of take advantage of an inflecting cycle. I know there was some questions about TI and analog devices as well at some point. Our estimation was Q1, Q2 was going to be the trough of the analog investment cycle, and we're going to start to see an inflection positively as we move through 2024. That played out. Analog reported earnings last night, and the stock was up 10 or 11% following the earnings report. But what it did was basically confirm for us that we're starting to see an improvement in chip demand, analog chip demand. That will benefit TI, that will benefit analog devices. But it confirms sort of some of our thesis around the Best Buy story, that the demand for some of these chips that go into PCs, or even things like refrigerators and other industrial products, has bottomed and should start to improve as we move through 2024. So I think the combination of the free cash, the dividend profile, and a product cycle story that it may start to materialize as we move into 2024, the back of 24 and 25, I think sets up Best Buy to be a pretty good investment opportunity, especially for an income fund with a 5% plus dividend yield. They're survivor. I mean, Circuit City went under, kind of like Dick's Sporting Goods. They're a survivor. There's only 1 or 2 of these sort of technological platforms where people can go out and, look and feel. You can go to an Apple store, obviously, but and places like Target and Costco have them as well. But I think our feeling is Best Buy is a 10 PE stock that's a survivor in a retail industry with a product cycle ahead. That should make it a pretty good investment for the next two to 3 years.
Thank you. I appreciate the stock-to-stock comparison. I was just curious if it indicated a moving away from materials, which is usually a small sector anyway. Is there an expectation that we're gonna see a more pronounced change in sector analysis?
No, I think we'll always look for opportunities, and you know, if you dig more into the evolution of sort of power and what's happening with electric vehicles, with power generation, with data center growth, there is demand. There's demand for copper. There's demand for a lot of the products that go into these, and whether you believe EVs are a thing of the future or not, the growth trajectory is still pretty good. It's still growing faster than the combustion engine. So there's more of them being built, more materials go into those cars, whether it's the batteries, the lithium batteries, whether it's the aluminum that goes into the actual car itself. So I think there's still a good story for materials, especially if inflation remains sticky. As Lindsay said earlier, you know, the last 3 or 4 inflation prints have been higher. That tends to be good for materials companies, gold, and other sort of commodities. So I would say we're not moving away from materials explicitly, and on a case-by-case basis, we would look to add if we found the right name.
Okay. Moving to investment policy. The common principal fund is not expendable. The income from that fund goes to the income fund. And we can spend capital gains out of that account. And you've had, politically, or we've all had good success with that income fund, and the principal as well. But we've been talking about a little more growth orientation to the income fund where we're free to have that. And in order to give guidance to ourselves and to you, we need better language in our investment policy. We're thinking 10% growth, maybe 15%, but we want to have some workable language. Kathy, I think, is going to be our new language smith. So, so anyway, if you have suggestions in that area, stuff that you can deal with, we had a 3 to 4% yield goal last year. We've easily exceeded that with just by sitting on cash, for crying out loud. Should we be changing that, or should we be rewording it? And the timeline here is that we normally talk about this now, we get some language in place in June, and then we vote, and we have to turn in the new investment policy to the state in September, 1st of September. So that's kind of the timeline we're working on, but if you have language suggestions that everybody can work with, we'd love to hear it.
Absolutely, we would be happy to work on wordsmithing something and circulating that to you to help provide some examples.
Okay, I had thought you might have had something today. Our next meeting is probably June 14th.
Okay.
So something a week or more in advance. We set the agenda a week ahead of time, so someplace in the first week of June would be helpful if that doesn't put too much pressure on anything. And of course,
We can get that over to you.
it's not,
No question.
you know, carved in stone, but I think a mutual sense of direction is beneficial to us all. Unless somebody disagrees and just say, you know, we ought to be banging the hammer.
No, but I think, don't think growth just means, 7 stocks. I mean, there's a lot of examples of mini stocks that are growth stocks that have done very well in recent and over history. So, the verbiage around what defines growth. I mean, anybody can listen to the news and say, oh, buy NVIDIA, buy Microsoft. I'd like it to be a little more definitive than that.
Definitive how?
Well,
What do you mean by when you're defining a growth stock, it's,
I mean, like, should it be a small cap, a medium cap, a large cap? Should it be in a certain sector? Should it be broad-based, selective, this, how broad should it be, how specific should it be, is, I guess, my question. And, we don't want to handcuff you guys, I was gonna bring up, just for example, Quanta Services, because he was talking about power and infrastructure and NVIDIA and everybody needing all this. Quanta Services is a growth stock that's exploded, So how do you select a Quanta Services versus an NVIDIA or something else? I'd like to give you guys the latitude so that you're not handcuffed into some little small segment, technology, quote unquote, or whatever. And again, we're talking policy and basically, putting the guidelines in writing, and, we're not talking like the selection process necessarily.
Right.
So,
Well, I think for the most part, we've been large cap. More mature companies before we get into them. I don't know anything about Quanta Services. What's the symbol?
it's PWR.
I never would have found that, okay.
But anyways, Chris, I would argue against that. I mean, if we're gonna let them do growth and they identify this fantastic company in biotech that's has a phase 2 results that's, very favorable, do we let them, I mean, do they have the latitude to buy that company, or is that no-no? I mean, could be explosive growth if they're gonna, solve some major medical problem.
You see what we're struggling with. Need you to resolve the struggle. From that point on, I won't,
Well, Ryan's gonna say something.
I was just gonna say, it's a very valid question, and it's something, sort of, we can work with you on identifying some of that. Costco is a growth company. I mean, there's a lot of growth companies that are sort of established large cap growth companies, right? And we have services, whether it's Morningstar or other things, that identify companies and put them in a sort of matrix of, this is a large cap value, this is a large cap growth. So we can certainly share more growth companies with you, and certainly we have plenty of those types of companies.
I mean, I wish we had bought Eli Lilly, a year and a half ago. Would you consider Eli Lilly a growth company?
100%.
Back in, that company's-
Last year it traded at 35 times earnings, and today it trades at 40 times earnings. That's a growth multiple, but it's reflective of 50% revenue growth due to Zepbound and some of these GLP-1 drugs, which we feel like we're in the first inning. So I would argue that Eli Lilly, the growth path ahead for Eli Lilly is not 1 year, and 5 years from now, the entry point is gonna matter less, because I still, think there's 20% growth per annum ahead. So again, to us, that's a growth company, and that's the growth trajectory. Our general philosophy is we typically wouldn't play in the space of a biotech company with a phase 2 because it's a very binary outcome, right? And it's hard for us to analyze that and say this is a sustainable, consistent growth stock or a consistent growth stock. Doesn't mean it might not work 100%. It's just that the universe of stocks we tend to play in is a little bit more defined. It's a little tighter in terms of consistency. Still have plenty of growth stocks across the board. Whether in utilities, NextEra Energy is a growth stock. That's a growth utility.
And it's pretty cheap now.
Yeah, 17 times, right? So we could buy a value utility at 10 times that has exposure to coal and other things that are going down, or we could buy a renewable power in a demographic like Florida where population is growing and you're getting more power from renewable sources. So there's different ways of looking at it, and Lindsay, I can work with Lindsay and Eric to try and help you guys identify some of those if that's attractive.
We just need a policy so that somebody calls us on the carpet and says, hey, why did you buy this phase 2 biotech company? Oh, well, here it is. You know?
Okay. Any last comments on investment policy? All right, on the agenda, we have a couple of other things coming up. For Lisa, you're gonna be getting a bill soon, but we haven't got it yet, for the flower funds. I have ordered flowers, but they're not doing annuals anymore, so we're getting hanging baskets without the wires. And new ownership at the flower shop, so we don't have an exact price. But we probably ought to have a motion to allow
I motion
$150 not to exceed.
I motion $200, not to exceed $200.
I'll second.
Yeah, because that bill will come in next week probably. We need to pay it before the end of the fiscal year, so. All in favor, signify by saying aye.
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 Okay. You will see that coming sometime, Lisa. I don't have any requests from the school district.
What about the 90K for AV equipment?
Excuse me. We do. We approved up to $90,000 for audio-video systems for the schools, for 3 schools. They've done 2. So we have a bill for, if I can find it, wait a minute. We got a whole bunch of stuff all came in last night and the night before last. Of course, it's always the last one you pick up. $41,977.58, so that's for 2 schools. We don't know what the third one's gonna be, but these 2 are equally priced at $21,000 or $20,000 and change each, so. If we wanna authorize the $41,977.58, that would be a good move for us.
Do we need to make a motion on it? Since we already,
Not really, we've already authorized the 90,000, so
Yeah.
I'm just letting everybody know we're okay to pay.
They sandbagged us.
And okay, we have an invoice for the Abby Griffin Fence Fund. $33,000, was $33,750. However, I passed out our latest MS9, and the accumulated income in that fund is $12,251.71 as of April 30th. Could be more today, could be less next week. I have a couple of thoughts on that the town obviously, I've talked to Paul, and the town obviously knows that we're not gonna pay the $33,000 because we don't have it. So they're prepared to accept a contribution, if you will. I think we can't totally empty the fund. There's a question of how much we think we ought to keep as a basis for future growth. If there are repairs needed to the new fence.
How often have
We don't predict that. I went back 20 years, 2007, that's less than 20. I went back to 2007, didn't find any expenditures in that. The town looked at repairing the fence and decided it was cheaper to replace. So that's where we are right now. And if you have a feeling for how much we want to pay towards that 33,000, then I think a motion to that effect would be in order.
I mean, other than be arbitrarily, do you have a suggestion?
No.
I mean, okay, I'll throw out $10,000.
That's nicer than I was gonna say.
Excuse me?
That's nicer than what I was gonna say. I was gonna say 7, but I'm okay with,
I mean, I just wanted to
yeah.
put a
7
number on the
doesn't get very
table for
far.
discussion.
I mean, is there any indication of how much the town is willing to pick up? Like, you know?
I
is
don't
there-
think they have a choice. We only have.
They've already paid the bill.
Okay,
So
so
we're
this is
just,
just
do
a-
you have any input, Paul?
No, I think, just looking at the principal balance, I think 10,000 would be a reasonable amount.
Okay.
All right, is that a motion, is that a second?
Sure.
All in favor signify by saying aye.
Aye.
300. And it says in the agenda, nothing from the MVD, that we did receive $1,099,943 to go into capital reserve funds. And then yesterday, I received a couple of requests from the MVD for $100,000 for land acquisition, and there's one, 89,410, I think it was, for a couple of new trucks. So let's do the land acquisition first. I have copies of their letters here if you want to look at them. But essentially, the land acquisition is a multi-year project where they're buying an easement and $100,000 now and another $125,000, I think, when and if they ever dig a well and actually have income producing from it. So that could be 5 years from now, it could be 50 years from now, it could be never. But the $100,000 is what they're looking for today. They have just released some extended minutes from a non-public meeting. So that's why that has been delayed, if you will. So do you want to?
I'll make a motion to approve $100,000 from the land acquisition fund.
Second.
Thank you. Any further discussion or questions?
Nope.
All in favor, signify by saying aye.
Aye.
300. And on the trucks, let's see here. One F-150, one F-350. And looks like 84. Just double check me on that number.
$89,401 for an F-150 and an F-350.
89,401.
Yes.
Thank you.
I'll make a motion to approve $89,401 from the Water District's Equipment and Facility Fund.
Second.
All in favor, signify by saying aye.
Aye.
Aye. 300. So, Lisa, you can expect to see expenditure requests within the next few days. Isn't that exciting? But they
Enjoy
gave
the-
us $1 million last week, so that's not so bad. They have also asked that I attend, or somebody from our board, attend their June meeting. I'm not sure the date. They meet on Monday nights at 5 o'clock, and I'm happy to attend. If anybody wants to come as well, that's fine. I think it's just a generic, here we are, here's what we do kind of meeting. They had some discussion at their annual meeting from the general public as well as from town manager and one of the town councilors that they have I'm trying to think of the appropriate word. More money in their pocket than they really need. They have a $4 million budget. They have $4 million in reserves. They got $6 million in capital reserve funds. And there's some pressure on them to re-examine their finances, whether it's to reduce rates or do something else. But in my mind, part of their problem is when they come along with new treatment plants or something like that, it's an all of a sudden we need $400,000 or $2 million. And so they're prepared for it. Whereas when we get $2 million needed for roof for the schools, they have to put it in the annual budget every year. So it's a different philosophy, and we need to just be in sync with them, I think. So that's the plan for the meeting, as far as I can tell. If anybody wants to attend, I'll let you know
What
when the
date
meeting
was
is.
it again?
I'm sorry?
What was the date again?
I think it's June 7th. No,
It's a Friday.
June 7th?
no, wait a minute.
June 9th. No, I'm sorry.
It's a Monday.
Either the 3rd or the 10th? Must be the 10th.
Well, looking at the calendar, the 10th or 17th.
I'll see you before that. Let me
Yeah.
know. Please.
Okay. Do we have anything else? Anything else from anybody at Cambridge Trust that you want to bring up?
Your end is coming up, so we'll be ready for that.
and we don't meet in July. We do need to pick a June meeting date. We have either the 14th or the 21st, and the key ingredient there is the 1.5 million from the town, for the town, that we need to get that in line and then have time to do the transfer back into the town's account, so everything clears before June 30th. So if it's a wire transfer, the timing is fine. If it's gonna be a manual check or something, then we really ought to meet on the 14th. Do you have any input on that, Paul?
I think we can do the 21st. Is it typically a wire transfer, Lindsay?
Yes.
Yes, we can do that. Yep.
Perfect.
21st, okay with everybody?
Good for me.
First day of summer.
Not this year. It's a leap year.
I'm sorry?
Not this year, it's a leap year. It's the 20th this year.
Oh, okay. Then it's my
Second day.
wedding anniversary, so there.
There you go.
Okay. There being no further business, I'm just gonna say we adjourned at 10:15. Thank you all for coming.
Thanks for coming, guys. Have a nice weekend, long weekend.